Sorry about that. The filming issues here. All right, where were we? And of course, this thing's not working right now. Hold on a second. Okay, so before we had our little issue, we were on this slide, and we were talking about the weighted average cost of capital, and I was describing the fact that it's a weighted average. These little points here are the weights. Now they throw in this P over V weight, which wasn't on the previous slide, which might confuse you, but they're just basically throwing in if this particular stock had preferred stock, which a lot of times it doesn't. So you could consider this to be non-existent, this portion of the formula. But if a firm has equity, this part would be meaningful, and if the firm has debt, this part would be meaningful, and if they have preferred stock, this part would be meaningful in order to calculate the weighted average cost of capital. The weights, pretty straightforward. We already discussed them. The RE stands for the firm's cost of equity. RP is the firm's cost of preferred stock, and RD is the firm's cost of debt. The only undefined variable is the T, which is the firm's corporate tax rate, and that is only going to affect the debt portion. And the reason for that is because of the issues with debt and interest being tax deductible. So that's why you see the tax rate fall in over there. So here we're going to have the overall return the firm uses to earn, the overall return the firm earns on assets to maintain the value of its stock. That's what the weighted average cost of capital is. The overall return the firm uses on assets to maintain the value of its stock. All right, so let's do some estimating of the weights. If I can get this thing to let me go forward. All right. This isn't letting me go forward without me picking this up. All right, estimating weights. All right, so let's just say we have this given information. Stock price is $50. 3 million shares, common stock, $25 million in preferred stock, $75 million in debt, 40% tax rate. You can immediately compute component values from that. For example, valuation of equity, $150 million. The valuation of preferred stock, $25 million. The valuation of debt is $75. Total value of the firm, $250 million by adding all the above. And then you take the weights of each. So the 150 from equity over the total, it'll give you 0.6. And you do that for all the above in order to obtain the weights. So if we did have the following weights, like a weight of 0.3, 0.1, and 0.6, for example, and you had the following cost structures here, you could actually obtain, these are actually the ones we've computed throughout the PowerPoint presentation. So if we did go about doing that and plugging all the information in, you'd end up getting 11.1% for your weighted average cost of capital. It's pretty straightforward. This chart is very useful, especially for you guys considering our circumstances, in order to just describe everything we've just discussed. Is pretty much on this chart. So this is a good summary slide for everything we've discussed up until now. Oops. Okay. Certain factors can influence a company's weighted average cost of capital. Clearly, market conditions can affect a firm's cost of capital. If market interest rates rise, then both the cost of equity and debt will rise. If market risk premium increases, the cost of equity increases. A lot of things can affect the weighted average cost of capital. The firm's investment policy, firms with riskier projects generally have higher weighted average cost of capital. So all of the above are important. You can actually use data that exists on Yahoo Finance to go about computing a cost of equity, for example. And then you could do the same to compute cost of debt, for example. I'm not going to have an opportunity, given my kind of constraints here, presenting this information, to be able to do what I typically do in class, which is, go to the slide, then show you how you could obtain this information on Yahoo, which is showing you down here as the source. This information is publicly available. If you're ever curious about where exactly you can obtain all this information that we're about to go through, just ask me in class and I can show you where you would go about obtaining this information. But let's just kind of walk through this. In order to compute the cost of equity, let's pretend we're back in time, because I think this was very, very long ago. In past classes, I've updated it, and the numbers are nowhere near where they used to be. But if you went to Yahoo and you looked at Eastman Chemical Company, you could easily find their last trade value, the current stock price, and that's what they're looking for here, and that's what's highlighted in red with the red box. You could also easily find on Yahoo, and I'll show you this if you'd like to look for this. It's in the analyst estimate portion of Yahoo key financial indicators for this particular firm. You can find information on dividend growth, and here you can see this particular firm, EMN, versus the industry and sector and so on and so forth. We have it circled and it's at 7%. I know the last couple times I've looked, it was closer to 9%. Whoops. You could also dig into beta information, obtain information on, this is the beta, shares outstanding, even the forward dividend rate. This is in key statistics within Yahoo Finance for this particular firm, Eastman Chemical. Just dig around in there, you'd find this exact chart, and we're basically stealing the information out of here in order to make it. We're going to make a calculation at the end, taking all this information. And then there's other information, market risk premium. They're assuming a 7% market risk premium. The T-bill, the 90-day T-bill, is assumed to be 0.07%, which I don't think is correct. The tax rate they assume is 35%. But then they go about showing you here that they go to Reuters to check their beta and see what Reuters beta is, which may be different from Yahoo's for this particular company. So what they do with those betas from Yahoo, they take Yahoo's, they take Reuters beta, and then they average the two of them. The T-bill rate was given, the market risk premium was given. So they can obtain, using the security market line or the CAPM approach, depending on your terminology, they can obtain an answer here for the cost of equity, which is what they're looking for, which is 13.83%. So the point here is that you can actually obtain real statistics via Yahoo, maybe using Reuters, to obtain information on this. So this is not just theoretical. It's something that you could actually obtain information on relatively easily. And once again, typically in class we go to Yahoo, we kind of sort around in there to find this information. just to show you that it's available. I'm going to count on you guys to do a little digging on your own if you're interested, just to see that you can do that. All right. If you recall, we also talked about the growth rate, and we looked at the last dividend. We talked about stock price, and the reason we were digging into that information is because of the dividend growth model approach. And if you use that approach, you'd end up with a cost of equity of 10.55%. So we ended up with two different costs of equities. Let's go back. I'm sorry. Using the SML method, we ended up with 5.83, and with the dividend model,